Hey everyone, welcome back to Corporate Decoder, the place where we sometimes feel like debt collectors. But for corporate America, today we're diving into a filing that shows Veradigm Inc. is making some interesting moves with its debt. Veradigm is basically saying goodbye to a big chunk of its convertible notes, and we're going to break down what that means for you. This filing is an 8K report, which is like a special announcement for big, unexpected news from public companies. Think of it as a company's way of ringing the alarm to let investors know something significant has happened. The company we're looking at is Veradigm Incorporated. They've been around and are listed on the OTC expert market under the symbol MDRX. The big event here happened on the 29th of September of 2025. So what exactly happened on that particular day that warranted an immediate report to the public? This section item 8.01 is where companies talk about other events. It is a catch-all for significant things that don't fit neatly into other categories, and in this case it looks like Veradigm has been busy dealing with its debt. So Veradigm Inc, which we'll call the company for simplicity, entered into what is called a repurchase agreement. Basically, they agreed to buy back some of their own debt. Specifically, they bought back about $44 million worth of their convertible senior notes that were due in 2027. These convertible notes are a bit special because they can be changed into shares of company stock. To do this, they paid out around $50 million. Now, you might notice they paid more to buy back the debt than its face value. That means they essentially paid a premium. Think of it like buying back a used car for a bit more than you'd expect, but maybe you really want it gone from your lot. It's important to note this wasn't a public offer where anyone could sell their notes back. This was a private negotiation with a specific debt holder. Companies sometimes do this to manage their debt without causing a big stir in the market. After this big buyback, there is only about $20,000 worth of these convertible notes left. This significantly reduces their outstanding debt of this type. It signals a move to really clean up this particular debt obligation. Now, what does this all mean for Veradigm Incorporated? Well, buying back debt, especially at a premium, can signal a few things. It could mean the company has excess cash and sees this as a good investment to reduce future interest payments and financial obligations. It could also be a strategic move to simplify their balance sheet or to gain more control over their capital structure. On the flip side, paying a premium means they are spending more than the debt, face value. This could hint that the notes were trading above par for some reason, perhaps due to an anticipated conversion into stock, or it could simply be the price they were willing to pay to get the deal done swiftly and quietly. Let us consider the implications. By repurchasing this debt, Veradigm is reducing its future interest expenses. This is generally a good thing for profitability. It also reduces the risk that these notes might be converted into new shares, which could dilute the ownership of existing shareholders. Looking at the bigger picture, this move suggests a company that is actively managing its financial health. It is not just letting debt sit around, they are making deliberate decisions about how to handle it. This kind of proactive financial management is often viewed positively by investors. However, we must also consider where Veradigm stands in the market. While this report doesn't give us the full financial picture like a 10Q or 10K would, this 8K tells us they are making significant moves. Let's think about potential risks and opportunities. An opportunity here is indeed the deleveraging of the company's balance sheet and the potential for improved financial flexibility. An interest rate environment where rates are higher or expected to rise could also make such a repurchase attractive if the company believes it is locking in a better outcome than continuing to pay interest. A key risk could be related to the cash used for this repurchase. If the company used a substantial amount of its operating cash or drew on existing credit lines, it might impact its ability to fund other important initiatives or weather unexpected economic downturns. Without seeing their full financial statements, it is hard to be certain about the impact on their liquidity. Ultimately, this repurchase agreement signals a company trying to gain better control of its financial destiny. It is a strong move towards simplifying their capital structure, reducing interest burdens, and potentially increasing financial stability. While the premium paid is noteworthy, the strategic benefit of significantly reducing outstanding convertible notes usually outweighs the immediate cost. It suggests a leadership that is assessing its debt situation and taking decisive action, which is generally a positive sign for the company's direction. Alright, that is our breakdown of Veradigm's latest filing. What is your take on these debt buybacks and what they signal for the company? As future, drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.